Welcome, everyone. We have a great company to look at today. Finally, we're starting to look at gyms, and we looked at other companies that would have been affected by the COVID crisis, and gyms in particular have been, although there seems to be a silver lining with a lot of them. So today we're looking at the Gyp Group, and Ted, this is actually a request from one of our viewers again, right?
This is indeed. So here it is. We had a KP Crisp asked us if we could have a look at the Gyp Group. So why not? Let's dive in.
Absolutely. And just brief look at this group, and Ted will go into this into far more detail. They obviously have not been immune to what's been going on. You will see that their revenues have taken a hit. But what was really interesting, and I know this because I have a friend who owns a chain of restaurants, they are starting to snap up retail space that typically would have been really, really high end and too expensive for them. So companies like the Gyp Group have an opportunity to take some of that retail space at a ridiculous discount. And thereby expand their reach. So PwC did some research about this that said, look, the gym space is going to be growing, the fitness space is going to be growing after we get out of the pandemic. And it looks like the Gyp Group could be of an interesting player in this area. So, Ted, take it away. I'm really interested to see what the finances show about this company and how they fared.
Excellent, certainly will, Moeed. Yeah, I think it's just worth just giving a little caveat. Some of the comments we've had is that we don't understand the business that well. This is very much financial analysis. So what we're doing here is we're digging into the financial analysis, the latest annual report and accounts, and we're trying to draw some conclusions from that. And then if you know more about the business, if you know that they've signed a deal or they've launched a new product or whatever, then do add that in the comments so that we kind of get a better picture of the company. So this is not the all singing, all dancing, analysis. You watch this video, you don't have to do anything else. This is really focused on the latest set of financial statements, but there's going to be other stuff going on that we are not aware of. So I think that's just worth making that point, Moe. So here we go into the Gyp Group. So let's jump straight into their income statement, which is all the way down on page, I don't even know where it is. It's right down. It's very much
95, I believe.
95. Here we go. So here we go. So onto the income statement. And the first thing we see is, as a result, and this is a year ended 31st December, we can see very quickly that the sales have fallen dramatically. So almost half down on the previous year, and we kind of expect that. Now these guys have a very much a low cost model. You're signing up for a membership, there's no contract, there's no joining fee. You sign up for a month, and of course if your gym is closed, you're going to cancel your contract. So the fact that they managed to turn over 80 million odd pounds, I think is actually quite impressive for these guys. Obviously, when the the lockdowns were eased, people were able to go back to the gyms. And what you'll notice here, and this is kind of the Achilles heel of this company, is this line here, is that while your sales may halve, your costs remain the same. So this is what's known as a very high operational gearing company. It's got very high fixed costs and very low the cost of sales is effectively, this cost of sales number here is effectively irrelevant. That's just sort of in-house products which they're selling. So this is a fixed cost business. You'll find a lot of the staff have been will have been furloughed. But what you'll also see is that this includes things like rent, and they've had to carry on paying that. And that's resulted in a pretty miserable result for the year. There it is. It's £36.4 million loss. So revenues right down. And you'll also notice this line here. They've got a lot of debt sitting on their balance sheet. They've got debt and they've got to be able to service it. Now, when things are going well, the ability to service that debt isn't a problem. But when things aren't going so well, suddenly we get quite a few alarm bells starting to ring all over this company. So the P&L really doesn't look good, but there's no reason, if they were on 153 million in 2019. There's really no reason why they shouldn't be able to start to push back to that, certainly in 2021, as long as we come out of lockdown, as long as the gyms can stay open, as long as this is a one-way street for the roadmap which is being instigated by the government. So when we see this, it's worth then bearing in mind, we might just go back to the statement by the actual directors in the directors report, which you picked up, Moeed, and this one here, the going concern, and it's really just talking about, this note basically says COVID has taken us a massive hit. We're really, really struggling. If the government continues to close us, we're going to go bust, and that's out of our hands. There's nothing we can do about it. So the point there in the middle, as it says, cash burn when gyms are closed. It says, we're still spending and there's nothing we can do about it. We're a fixed cost business, which not like we can just turn the taps off, for example, and hunker down. We've still got to maintain rent, rates, and all that kind of stuff. So that's kind of the point from the directors, and it's a significant point, and the auditors in their audit report also make that reference. I think that's on page 92 here. Yeah, so here we are on the independent auditors report, and they again give the conclusions relating to the going concern, and they say, yeah, you know what, the directors have stated it, they've put it into the accounts. If you're an investor, you got to go in eyes wide open on this one. So this company may not be around in the next 12 months. However, gyms are open right now. It's a one-way roadmap. That's what the government are saying. Vaccinations are happening. There's no reason, I personally can't see any reason why this doesn't start to grow. So let's go back to our P&L and move on through the P&L and look at the balance sheet. So here comes the balance sheet. Balance sheet looks actually okay, apart from one very obvious thing that will jump out at us. So when we look at the balance sheet up here, we've got all of the these are the assets. They've got quite a lot of property in there, about 171 million. And as you mentioned, Moeed, they should be able to pick up some more property there. Just because there's going to be a lot of sort of empty lets and businesses which have closed that didn't survive, so there could be an opportunity to expand there. And then we've got this second line, which is the right of use assets, which is basically all the kind of the treadmills and the rowing machines and all the weights, etc. And those have been bought effectively on lease. So we will see if we just clear those and move the balance sheet down a little bit, we can see that these assets here are very similar to this number here, which is effectively the lease liabilities. We can see the borrowings. Here's the borrowings line in the middle. It hasn't really changed, and the borrowings will be funding a lot of these assets. So effectively, they're borrowing money to buy property, and they're leasing the gym equipment, which kind of makes sense for them. The thing to really notice here, though, is that the current assets of 10 million compared with the current liabilities of 43 million. Now, in anybody's world, that's a massive red flag. So this is effectively saying for every £1 they owe and have to pay soon, they've only got 25p either of cash or coming in as cash soon. So that should be a very, very big red light. But I'm not sure it's as big a red light as we think. And I'm going to show you why I think that they're okay on that at the moment. Just before we leave the balance sheet, just to look at this line here, this shows the amount of cash they've got. So their cash has gone up a little bit. It's £3.7 million right now. But we'll see why that is in a minute when we look at their cash flow. Before we get to the cash flow, we go through the movement in equity. And just to point out here, last year they paid out a dividend. So 2019, they paid out a dividend. Obviously, that would be before COVID actually hit. And there's no dividend this year, a shocking great loss coming through. And they are sitting on a retained deficit of 44. That number should actually be a negative number. Somebody's forgotten to put the little brackets around it, but not to worry. We know that that is effectively a deficit. So this share premium, this is what they've actually raised in order to build the company, and then we have this. They've basically been booking losses here. Moving down to the cash flow, here's our consolidated cash flow. Now, this is obviously very, very important for them because they're burning cash, which is really, really, really key for them. So the negative, so up here we've got their loss for the year compared with the operating profit from the previous year. But down the bottom, you'll see they're still cash flow positive, nowhere near where they were last year. Look at that, £70 million. Cash flow positive. And the reason that they are so positive is partly because a lot of their cost is this depreciation, which is a non-cash item, so they're just devaluing their properties, and the other reason is that their business model, everybody pays them up front. So if you remember, you're paying them up front, and then they're paying for their leases further down the line. They're paying their any rates and rents further down the line. So they've got cash in before they get cash out. So really, strong cash flows coming through from this business, which is good. Little bit of a nervous here, not so much a nervous, but you'll notice that there's a decrease in accounts payable. So if you owe money and you pay it down, it's a decrease in that accounts payable, and we'll show you why that pops up there in a minute. And there's also a decrease in accounts receivable, which is good. That has a positive effect on their cash flow. Bottom of the cash flow is quite interesting. So they're still investing. So they still got the pedal on the floor. They're still investing property, plant, and equipment. So that's not going away. They're focused on the future. Couple of things we want to notice is here. These two numbers are very, very important. So this is them refinancing their debt. You'll remember they had debt on the balance sheet, and they're refinancing it. So they're refinancing it, which means that the people who are lending to them are buying into the story. They're happy to continue to lend. Don't forget that debt will be fixed on the assets. Therefore, as an equity investor, the bank is secure. They're going to get their money back. They're happy because there's 171 million quid's worth of actual property there that the debt is secured on, which makes it maybe a little bit riskier for the equity investor. But the key thing to look at here is this number here. So here we see the proceeds from the issue of ordinary shares. So basically, these guys have done a share issue. So if you were a shareholder, you'd have been diluted, but they've raised a lot of money, and that money they're really using to keep themselves alive. So they've been using some of that in order to invest. Some of it they've been sort of paying down leases, for example, but they've also been, that's where they were paying off their creditors, for example. Keep the creditors on side, make sure that they don't default on any payments, and that they don't lose the gym equipment. The last thing they want to do is to lose that gym equipment, because if you turn up at a gym and there's no equipment, you cancel your membership, and suddenly the business model falls apart very, very quickly. There's just one other thing I actually found while I was kind of digging around in this, if we look down into the notes and we look at note 19, note 19 talks about so note 18 is the inventories, note 19 is the receivables. I just thought I'd highlight this one here. So here, what we see is the trade receivables. This is last year. So they were owed at the year end, they were owed just over £2 million. And they said, of that £2 million, we think that 88,000 we're not going to get back. Okay, and this is standard practice. Companies, they'll put in a provision for money that they're not going to recover. But at this year end, they're owed just under £1 million, but a quarter of it they reckon they're not going to get back, and that's a really high number. So that just kind of jumped out at me and said, that's kind of, maybe they're just being very, very prudent here, which is good, but that's a very high, no company can really operate on, unless you're kind of in Wonga's world, you can't really operate on a basis that I'm only going to get 75p in the pound of any sale, for example. And also kind of, what would be trade receivables, because people will be, they'll be on a direct debit. It'll be coming out of their bank accounts. They pay, then they use the machine. Or they use the gym. So I'm not sure exactly, what's in those trade receivables. Shouldn't be too big for this company. So hopefully we've kind of, we've managed to touch on the key aspects of this business. So I think, what we should really be doing then is looking at, what does the market think of this company? So here's the share price. It's been bouncing around a little bit. It's been bouncing around a lot, as you can see, even since they floated in 2015. But what I think is quite interesting is that the net asset value on the balance sheet is actually quite low. They've got a lot of assets on lease. They've got a lot of property, but they've got a few loans in order to buy them. Their working capital, looks low, but it's no different to the previous year. So it looks to me like they can operate at this very, very low working capital. And that kind of, they sail very close to the wind. When a COVID event comes along, that can just knock a company out very, very quickly, because they just don't have anything in reserve. They don't have that rainy day account, which it looks like these guys don't. Yet they do have over 3 million in the bank. Their net asset value is 155 million. The market valuation is 430 million. That's not a huge amount of goodwill. I mean, we're not in kind of Tesla or Facebook territory where it's all goodwill, although of course those are very, very different businesses. Obviously there's no PE ratio because there are no earnings for this company. But we've seen it in the press. There's a few people who are touting these guys as a play on recovery. We can see that recovery has potentially started already. We can see this kind of rising share price going up. But the question is it all baked in? It's kind of, if you're a chartist here, what you're going to do is you're going to draw your kind of, you either draw a dotted line across here and you say, look, what it's going to do is it's going to go up and then it's going to go down and then it's going to keep on doing this, for example. Or what you do is you say, look, it's trying to accelerate out. Is it going to push out of this trading pattern? Is it going to break that top? And if so, where's it going to go? I think this is quite an interesting company, quite an interesting play, if I knew it better.
Yeah, I agree. And it'll be interesting to see how the executives of the business make the right decisions about some of the retail spaces, some of the locations that they're buying. I think they bought one recently in Oxford Circus, which theoretically before COVID would have been a really good location, lots of offices there. In fact, I used to be a member of, I think it was Virgin Active, and they had an office near Oxford Circus. But, that's banking on a lot of people going back to the office spaces there. So we'll wait and see how that works. Interesting to look at the share price, comparing that to the fundamentals, the financials. So great business to look at. Love to hear any people who know the gym industry really well and can provide that other context. So we've provided the financial context and the analysis. And as Ted said, that's only one dimension that someone would look at in terms of the health of a company. Does anyone out there know the other dimensions, right? So do they know about the gym industry? Can they shed some light? Like, share, subscribe. And of course, hey, we're getting a flood of requests from viewers now. So be one of those viewers who wants to have us analyze a company they're interested in. So Ted, thank you. That was a great one.
Also for sale.
Oh,
yes.
If
you want to do some more financial analysis.
Yeah, that's how we got to know each other, right? I can vouch for his book. I picked it up from Waterstones and loved it, and I reached out to Ted. So yeah, I can vouch for that. If you are not if you're not an expert in the financial world, but it's obviously going to be important for you, great book to read. Great plug as well, Ted. All right, everyone, have a great one, and we'll see you on the next video. Thank you.
See you later, Mary.